A monkey wants more bananas. To get them, he plants a tiny banana sapling, waters it, and waits. Next week, nothing happens. The week after that, still nothing. But the monkey continues watering it, patiently, for 40 years. This 40-year wait is the heart of investing. You put small amounts of money towards something with the expectation that it will slowly increase in value over several decades. We are going to set up an automated, low-maintenance investment portfolio using a simple app. A properly designed financial system grows your wealth in the background. It allows money to work for you while you focus on your daily life. Step 1 is identifying why cash loses value when it sits still. If you leave money in a standard bank account, it remains static and isolated. This diagram shows inflation. While your leaf pile is static, the banana price tag actively ticks up from 3 to 6 leaves. To maintain your standard of living, your money must grow faster. Here, the leaves multiply at 6%, outpacing the rising prices. Investing serves as a mandatory defense mechanism to protect your purchasing power. It ensures your savings keep pace with the real-world cost of living. Step 2 is selecting your assets. Every investor must balance the potential for long-term reward against the risk of a total loss. This graphic ranks common assets by their risk profile. Picking individual stocks or buying NFTs sits at E tier due to extreme volatility. Real estate lands at D tier because of high entry costs, while crypto remains at C tier and gold at B tier. Index funds and ETFs represent the S tier choice for beginners. They provide the most reliable path to long-term growth with the least amount of management. An index fund spreads your risk. One large leaf automatically splits into 500 fragments, distributed across the largest companies. This is diversification. If one company fails and collapses, your other 499 investments remain stable. Your total value barely moves. S-tier assets eliminate the need to guess which individual company will succeed. You are simply betting that the economy as a whole will continue to grow over time. Step 3 is choosing your strategy. Active investing involves staying up late, analyzing technical charts, and stressing over the perfect time to buy the dip. This split screen shows the alternative. This passive strategy relies on an automated schedule that puts your money to work while you sleep. We call this dollar cost averaging. You invest a set amount on a recurring schedule, like every Friday, regardless of whether the market is currently up or down. Dollar cost averaging removes human emotion from the process. It ensures you keep buying through every market cycle without having to make a difficult decision. Step 4 is budgeting. Calculate your essential expenses for food and housing first. Allocate only what is safely left over to your investments, even if it's a small amount. Open your investing app, choose your S-tier index fund, and flip the recurring weekly investment toggle switch to on. Step 5 is setting your guardrails. Only invest money you won't need for the next several years. Maintain absolute consistency with your schedule and avoid the temptation to look for overnight riches. You must commit to holding your investments when the market inevitably crashes. When this chart plummets, your only job is to stay the course. Most automated systems fail because an investor panics and manually sabotages their plan. Fear leads to selling at the bottom, turning a temporary market drop into a permanent loss. Your automated financial system is now operational. It is designed to run without your intervention. Be patient with the timeline. Nothing visible will change in the first few weeks or months. Over 40 years, that consistent weekly contribution compounds. It eventually grows into a jungle of banana trees, representing substantial wealth and security. Financial freedom is the result of patience and consistent discipline. These qualities turn a simple automated system into a lifelong engine for wealth.